Welcome back to Iron Financial. This is the channel where we help you forge a stronger portfolio by cutting right through the market weakness. Today, we are putting Hess Midstream and its latest earnings report through a brutal stress test. Look, this isn't just about one company's quarterly numbers. This is about learning to see the difference between a rock-solid financial structure and a fragile house of cards. And the numbers they just dropped? They're going to test every single assumption you have about safety, about yield, and about risk. So let's see if this thing is really built to last.
Right. The company we're putting under the forge today is Hess Midstream, ticker HESM. So what are they? They're a fee-based midstream operator. Basically, they own the pipes, the processing plants, the storage tanks, all the steel guts of the energy sector, specifically in the Bakken Shale. They get paid to move oil, gas, and water for their customers. Now that sounds simple, right? It sounds super safe. But as we always say here, the devil is always in the details. And trust me, the details here are fascinating.
Okay, let's get into it. Here's our blueprint for the analysis today. We're not just going to read you a report. We are conducting a full forensic examination. First up, we are going to tear down that Q4 performance report, the immediate results. Then we're going to excavate the financial foundation itself, and we're going to pit their profitability against what looks like a mountain of debt. After that, we'll scrutinize the architectural plans for their future, their so-called blueprint for growth through 2026. And then comes the most critical part. We are going to stress test this entire structure against real-world pressures. And finally, we deliver the Iron Financial verdict. Let's get to work.
So let's start with that Q4 report card. When you're looking at the foundation of any investment, the top-line numbers are your very first inspection point. Are we looking at a solid, deep concrete pour, or are we already seeing some little hairline cracks forming? Because right away, these numbers tell two completely different, conflicting stories. One story is about a precision-engineered machine, and the other is about a foundation already showing some serious signs of stress.
Okay, first, the good news. And I'll admit, it's pretty good. Their earnings per share, the EPS, came in at 72 cents. That's a solid number. It met Wall Street's expectations right on the money. So from a bottom-line perspective, you really can't argue with that. It's a clean, solid hit. Honestly, it's the kind of number that makes you think this machine is running really, really smoothly.
Whoa, okay, hold on. The earnings hit, fine, I'll give you that. But the top line, the revenue, that came in at $404.2 million. And folks, that was a miss. To be specific, a 3.08% miss against the forecast. Now, I know what you're thinking. Some people might just wave that away and say, oh, it's a rounding error, but a miss is a miss. And the real question is, why did they miss? When your earnings hit the target, but your revenue falls short, there's a disconnect somewhere. So is this just a one-off problem, or is it a red flag that's signaling a much deeper issue at the core business? I'm not convinced we should just brush this aside.
And that is exactly the right question to be asking. According to the company's management, the main culprit was the severe winter weather that just slammed the Bakken region back in December. And this is where we see the physical reality that's hiding behind all these numbers. I mean, extreme cold doesn't just make things uncomfortable for the workers, it physically slows down production. The pipes get cold, equipment literally freezes up, and activity just grinds to a halt. We saw that reflected directly in their throughput volumes when you compare them to the same quarter last year. Oil terminaling, down 4%, gas processing was down 1%, and water gathering took a pretty big hit, down 5%. So the key takeaway here is that the physical amount of product moving through their system actually dropped. They're blaming the weather, and you know what? That's a plausible, temporary explanation. But it also highlights a key vulnerability in their operations.
All right, let's shift gears from the quarterly snapshot to the company's permanent financial structure. This is where we figure out if their balance sheet is forged from solid steel or if it's made of brittle, over-leveraged iron. This is where the real stress test really begins. You see, profitability and leverage are two sides of the exact same coin, and in Hess Midstream's case, the contrast between the two is, well, it's pretty stark.
Let's start with the pillar of strength. Just look at this number, 83%. That is their gross adjusted EBITDA margin. To be perfectly clear, that is an incredible, almost unheard of figure in this industry. Their own internal target is 75%, and they are just blowing past it. This tells you that for every single dollar of revenue they bring in, a whopping 83 cents is pure operating profit. It shows incredibly powerful operating leverage and just brutally efficient cost management. This is the core engine of the company, and on this metric alone, it looks like an absolute high-performance machine.
Okay, but just as we're admiring that powerful engine, we find a massive crack running right through the chassis. This quote from Guru Focus is like a bucket of ice water right to the face. An Altman Z-score of 1.8, That puts Hess Midstream squarely in what's called the distress zone. Now, this is a formula that was specifically designed to predict the likelihood of a company going bankrupt within 2 years. So how can a company with spectacular 83% margins also be flagged for a high risk of financial distress? The answer comes down to one word: debt. And frankly, this just doesn't add up for me. It's a huge contradiction.
And this slide illustrates the problem perfectly. The debt load here is just immense. Look at the debt-to-equity ratio. It's a sky-high 6.63. For every single dollar of equity in this company, there's over $6.50 of debt piled on top of it. That is a heavily weighted, almost dangerously unstable structure. And what's even more telling is their leverage ratio. That's their total debt compared to their adjusted EBITDA. It stands at 3.1 times. Now, why does that specific number matter so much? Because their own long-term target, the level that they themselves say is optimal and safe, is below 3.0 times. They are currently carrying more debt than even they are comfortable with. This is the source of that distress signal. The profit engine is powerful, sure, but it's bolted onto a frame that is carrying a dangerously heavy load. This is a huge concern.
So how does the company justify carrying all that debt? Well, they do it by growing. Despite those very valid concerns about leverage, the core operational engine is still getting stronger. For the full year 2025, their adjusted EBITDA grew by a solid 9% over 2024, climbing up to over $1.2 billion. Net income also saw some pretty healthy growth. This right here is the bull's counterargument, and you have to admit, it's a strong one. They'd say, yeah, the debt is high, but look, our earnings power is growing fast enough to manage it and eventually to pay it down. The core question for us is whether that growth is sustainable enough to outrun the risks posed by that much leverage.
Okay, so we've seen the shaky foundation. Now let's look at the architectural plans for the future. The company's entire bull case, it rests on a massive strategic pivot. It's a plan to transform itself from a builder into a cash flow harvesting machine. This guidance they've put out isn't just a forecast, it is the blueprint they believe will solve their debt problem and shower their shareholders with cash. This is their all-in move, their big play.
And this is where you can see the sheer scale of that shift. This right here is the single most important chart for understanding the HESM bull thesis. Capital expenditure, or CapEx, is the money they spend building new stuff, new pipelines, new facilities. After years of a massive, expensive infrastructure build-out in the Bakken, they are slamming on the brakes, hard. CapEx is projected to fall from about $270 million in 2025 down to just $150 million in 2026. That's a 40% reduction in a single year, and it gets even more dramatic from there. By 2027 and 2028, they expect to spend less than $75 million a year. The heavy lifting, the really expensive part, is done. The system is built.
So the crucial point to understand here is this isn't just some random cost cutting. It is a deliberate 3-step strategic pivot. Step 1, which they've basically just finished, was that multi-year construction phase. Step 2 is what we're seeing happen right now, a radical slashing of capital spending. And that directly leads to Step 3, unlocking what should be a torrent of adjusted free cash flow. All that money that was going into steel and concrete and labor is now freed up. The entire plan is to pivot from investing in assets to harvesting the cash from those assets. This is the end game.
And here is the promised result of that blueprint. The company is projecting 10% annualized growth in adjusted free cash flow every year all the way through 2028. This is the payoff. This is the big reward for all that heavy lifting and all that spending. And this growth isn't coming from finding new customers or building new pipelines. It's coming almost entirely from not having to spend on CapEx anymore. It is the financial equivalent of paying off your mortgage. Suddenly, you just have a huge amount of extra cash every single month. And this is the cash they plan to use for debt repayment and, of course, for shareholder returns. This is the bull thesis in a nutshell.
But is that future cash flow guaranteed? This is where we have to look at the fine print in their contracts. These are their minimum volume commitments, or MVCs. Basically, these are contractual promises from their main customer, which is now Chevron, to ship a minimum amount of product through their system or pay them anyway. Now, for 2026, these MVCs provide a 95% revenue floor. That's an incredibly strong foundation. It's nearly ironclad for the next couple of years. But look what happens when we go out to 2028. The gas gathering commitment drops from 422 down to 346. Crude terminaling drops from 124 down to 99. So while the near-term cash flow looks heavily protected, a potential structural weakness starts to emerge just a few years out. If Chevron's production volumes happen to fall, that revenue protection weakens considerably, right at the time they're going to need it most. This is a pretty big if in their grand plan.
And that brings us to the most critical part of our analysis. We've seen the company's blueprint. I'll admit, it looks impressive on paper. But blueprints don't account for earthquakes or hurricanes. We need to apply a real-world stress test. Can this structure, with its heavy debt load and its ambitious cash flow plans, actually withstand the external pressures of the real market? Let's find out. And that really is the fundamental question, isn't it? It's easy to project growth and cash flow when you assume a perfect, stable environment. But the energy market is anything but stable. So what happens to this carefully constructed plan when the inevitable storms, both the literal ones and the metaphorical ones, start to hit? Let's break down the forces that could actually crack this foundation wide open.
Okay, here are the primary structural risks as I see them. First off, weather. We just saw it knock 3% off their revenue in Q4, and they're already warning us that it's going to hit Q1 of 2026. This isn't a one-time thing. It is a recurring operational risk in the Bakken. Second, and this one is huge, is customer dependency. Their entire model is built around Chevron hitting its Bakken production target of 200,000 barrels of oil equivalent per day. If Chevron changes its capital plans, if they reduce drilling rigs, or if they just shift focus somewhere else after the Hess integration is complete, HSM's volumes are directly at risk. They are completely at the mercy of their biggest customer. Third, macro pressure. Sure, their contracts have inflation escalators, but in a weird economic environment, even fixed-fee contracts can come under pressure if your customers are really hurting. Fourth, third-party volumes. They desperately need to grow business outside of just Chevron to diversify. And if that doesn't materialize, it's another big hit to the top line. And finally, the ever-present risk of regulatory changes that could impact the entire energy sector. Any one of these pressures could seriously strain their ability to execute that beautiful cash flow plan.
Now, the company's official response to that huge dependency risk is to frame it as a strength. Here's their CEO, Jonathan Stein, explicitly calling out the integration with Chevron. The bull argument here is that this isn't just a simple customer relationship. It's a deep, strategic partnership. Chevron needs Hess Midstream's assets to execute its own Bakken strategy. So they would argue that this integration provides a level of stability and visibility that other midstream companies just don't have. So, which is it? Is it a dependency risk or is it a strategic moat? The company is clearly betting on it being a moat, but it's the question that keeps the bears up at night. Okay, we've laid out all the evidence. We have inspected the foundation, we've reviewed the blueprints, and we have run the stress tests. It is time to bring it all together and deliver the iron financial verdict. After all of this, is Hess Midstream a well-fortified investment opportunity, or is it a cleverly disguised trap for investors who are just hungry for yield? Let's settle this.
And this slide right here perfectly summarizes the battle that we've been watching play out. On one side, you have the bull case, the Fortress. It's built on those spectacular 83% EBITDA margins, the massive game-changing CapEx cuts, that projected 10% annual free cash flow growth, strong contractual protection for the next couple of years, and a targeted 5% dividend growth. I mean, it looks formidable. But on the other side, you have the fault lines that are running right underneath that Fortress, the high leverage and that alarming Z-score, the heavy dependency on a single customer, the vulnerability to weather and macro risks, those declining MVCs that kick in after 2027, and of course that recent Q4 revenue miss that started this whole conversation. Each one of those is a potential point of failure that you simply cannot ignore.
So, here's the bottom line. The bull case is entirely forward-looking. It rests on the promise of a cash flow explosion that's driven by those CapEx cuts. If they can execute this plan perfectly, without a hitch, they will generate enough cash to strengthen the balance sheet, pay down that mountain of debt, and reward shareholders. The potential is absolutely there for them to build a cash flow fortress. But the bear case is rooted in the present reality. The debt is high right now. That Altman Z-score is flashing a warning right now. The reliance on Chevron is a major risk today. The structure is currently under a lot of strain. So any disruption, another bad winter, a shift in Chevron's strategy, a macroeconomic shock, could prevent that future cash flow from ever actually materializing. It'd be like a construction project that runs out of money halfway through. The risk is that investors are paying for a completed fortress based on blueprints, while what they're actually buying is a highly leveraged, half-finished building with some pretty significant structural risks. So our verdict is that HESM is a high-stakes bet on execution. It's a race between future cash flow generation and present-day financial risk.
And that brings us to the final, critical question for your own portfolio. The stock currently offers a massive 8.6% dividend yield. The market is clearly paying you a premium for taking on all this risk we've talked about. So the ultimate question you have to answer for yourself is this: is that huge yield fair compensation for the fault lines we've identified? Or is the market underestimating the strength of HSM's blueprint and the sheer force of that coming cash flow wave, making this a heavily fortified high-income opportunity? That's the decision you have to forge for yourself. Thanks for joining us on Iron Financial.